Hello, I'm your host, Efi Pylarinou, and today I have a very special guest, Keir Finlow-Bates, who is one of the big stars in my book, and I hope many others, around blockchain. He has a super talent to explain concepts that are philosophical and technical in a very business-like fashion. I will welcome you, first of all, Keir, to our show and to our guests, and I will continue to say more about you. First of all, welcome.
Well, thank you very much. It's an honor to be here.
Well, you are the founder of 𝐀𝐿. This is a company, you'll have the opportunity to explain more, that does blockchain research and development, and very much specialized in intellectual property. I know you from the early days of the crypto, blockchain, digital assets industry, because I was watching your YouTube channel called Thinkair, where you walk in the forest and talk about decentralization. And I've been very much inspired by your talks when I want a bit of a thinking or intellectual challenge. I do that, and I follow you on LinkedIn. And today we're going to focus on a topic that is quite important, that is staking, proof of staking and staking cryptocurrencies, and what is that all about and how it relates to banking. So let's take a deep dive in it. Can we start with you explaining to us what staking is all about, and is it really an innovation in depositing, and instead of depositing our digital assets at an authorized participant like a bank or a licensed financial institution, we are depositing them at what I like to think the God's protocol, you know, the blockchain. Is that the way? And I know this is a big topic. Can you introduce us to how to think about this?
Right. Well, I mean, I think the simplest definition of staking is where you have a system where people can take their digital assets and they can lock them up in a smart contract or in a system, presumably for some rewards. It's as simple as that. You have assets and you are providing them almost like a deposit, or like like when you go and rent a car and you have to put up some money at the car rental place before they let you drive out. And then at the end of renting the car, you come back, you return the car, you get your deposit back. So staking is meant to function kind of like that. And instead of a car rental, you have typically a smart contract on a blockchain that holds those assets and will only release them back to you when the right conditions are met. And then, of course, you have to ask, well, why would people do that? And they do it to obtain rewards, the equivalent of interest that is paid when you deposit money with a bank. And this is where the problem arises, because there are two kinds of staking. There is staking that is actually performing a valid service, and then there is staking that is a scam, that is nothing better than a Ponzi scheme. And the problem that stakers have in crypto and blockchain is that it can be very hard to determine whether you're looking at something that is actually genuinely of value or whether it isn't, which of course is always the case in investing.
Now, Keir, let's take a very concrete example. Let's talk about Ether. Nothing, you know, about that blockchain, but it's, you know, the recognized one where you can stake your Ether as the consensus mechanism is proof of stake. So you and I can stake our Ether, and when you say we get rewards for what? For performing some task, like I don't know, it's like a bounty type of a situation, or is it because like in traditional banking, when you deposit your money, on the other side, the financial institution lends it out and so on. And by the way, I have personally experienced this, because you only learn when you try things, right?
Right,
Instead of
absolutely.
reading about them. So explain to us that type of situation.
Okay, so I happen to think that Ethereum staking is one of the valid examples. And with Ethereum staking, what you are supposed to do is take 32 Ether, which is a substantial sum at today's prices, and lock it up in a smart contract on the Ethereum blockchain. And you are supposed to run a validator. So you're supposed to have a computer that is connected to the internet 24/7, and it is participating in maintaining and extending the Ethereum blockchain. The parallel would be Bitcoin with the miners. So
Yes.
a validator
You're
is like
really
a miner.
participating in
Yes,
keeping the network secure and
indeed.
keeping activity and so on.
Indeed. And you put up the 32 Ether. If you don't maintain your validator, you get punished. In the same way that if you bring a car back to the car rental and it's been damaged, they will take money out of your deposit to cover that. So and the question is, well, why would you do that? Why would you run this server? It's going to be expensive to have a 24/7 server reliably running. You're probably going to host it in the cloud. So there's going to be a cost there. You're taking 32 ETH in capital that you could be investing somewhere else and locking that up. And the answer is that every time another block is added to the Ethereum blockchain, the validators get a bonus for doing so. And I can't remember off the top of my head what percentages it works out at, but I think it's like 5% or something. Anyway, people watching can look it up. But there is a kind of almost guaranteed return as long as you keep things running. And of course, a lot of people can't be bothered with running the infrastructure, so you can outsource that by joining a staking pool. And that's what a lot of the crypto exchanges do. So in a sense, this has some parallels with banking, because I could, if I have money, become a loan shark. I could go and lend it to people, but that's a bit of a pain in the neck. So it's better for me to deposit it with the bank and receive interest on it, and the bank will do the work of lending my money out. And of course, they're going to lend it out at a higher interest rate to the borrowers than I get as a depositor, because, well, I mean, you can obviously see if they paid more interest to depositors than they did for loans, charged for loans, then people would borrow as much money as they could and deposit it. So, but the banks, of course, then use fractional reserve banking to take the deposit, lend it out, and then when it's loaned, the borrower usually gives it back to the bank as another deposit. So they multiply the amount of money they have. But that aside, yeah, it's staking in Ethereum. It's a bit like your Ether is like capital. It's like a factory. Your validators like the machines in the factory producing products, and the products that come out in the end make you money. And there is a queue then if you decide you want to quit and put your money somewhere else. You have to put a request to withdraw your stake, and it takes time for that to be processed. And this whole system has a purpose to it. It's as you know, as you said, it secures the network. It means that the whole system keeps chugging along with transactions being processed and added to the blockchain.
Yeah. So and what about the other type, what you call irresponsible or scammy or whatever? You know, irresponsible. Let's call it. It's very diplomatic, I must say.
Yeah, I think irresponsible. Well, in the early days, there were projects that were implementing the system because they were copying what they saw other projects doing without thinking what the implication is. That's why I hesitate to say at a blanket level it's a scam, because that implies that it's intentional. But really, they should have taken more care. And that irresponsible staking, the typical case is you have a project, it issues a token. Let's say, for argument's sake, they issue 2 million tokens, and they put 1 million of them on the market, and people buy them. Yep. Now, the project founders would like to see the token price appreciate. And one of the techniques for doing that is staking. They offer this opportunity to people who bought their token to stake them in a contract to lock them up and get rewards. And the reason why the founders want to do this is because by reducing the circulating supply, according to the laws of supply and demand, the price of the token should rise. And then the question is, where do they get the money from to pay the rewards to the people who are staking? And the answer is they use the second million that they held back and hand those tokens out as rewards. And what that means is if you are participating in this project as an investor and you don't stake your coins, you are effectively being diluted.
Diluted, yes.
It's like with shares in a company. When if the company issues more shares, the people who had shares find their percentage stake in the company is reduced. Now, with a company, you can do that because the company's value may be substantially increasing. And if the shareholders of the board vote on it, that's fine. What is happening in these staking scams is that the staking has become a trick to artificially inflate the price, and it's not sustainable. That's why it has elements in common with a Ponzi, because they're using these tokens they held back to pay the investors who stake and to encourage the investors to engage in a behavior that should, in the short term, increase the market price. But in the long term, it's really meaningless. And
this also reminds us here that there is a difference between investing in a token and investing in the company itself. I mean, theoretically, they should have some proportional relationship, but not. It depends on the tokenomics, right?
Well, some companies, some projects seem to be so focused on the tokenomics, you wonder what the actual real purpose behind the project is. I mean, it would be like a company being so focused on the day-to-day share price of the company that they made all their decisions solely on the basis of what they thought the immediate impact on share price would be. And that means you end up with a company that is not forward-looking. Companies should be expecting their share price to go up by their success, not by some kind of clever market manipulation on behalf of the chief executive officer. And it's a problem we actually see in companies when you have CEOs who've got a big share compensation package and it's tied to, say, a 4-year period. That makes a lot of CEOs only look 4 years into the distance. And of course, 4 years in tokenomics terms really, really far, because a lot of these scammy projects are looking in terms of weeks or months before they expect to be able to exit.
Yeah, and this also, it reminds us that the agency problems that have been recognized for years in traditional finance, right, with the financial incentives, with shareholders delegating to managers, CEOs, and so on, the decision making. What are the conflicts of interest, and how can regulation, especially in public markets, correct these? And we know that we don't live in a perfect world, and even these much more mature markets, in the sense at least of having a very long history, they haven't solved it, but it saddens us to see this kind of existing in the new world of blockchain, where it's trying to advance the way governance is done, whether it's an app, a business. It doesn't matter whether it's whatever the business model is, and we see that the problems persist in a different form. Of course, we could have a whole discussion around that. So let's go back to staking. What about stable coins? Are those also a part of the staking world? Can one stake stable coins? Is that a market?
Well, technically, you can write a contract that allows you to stake stable coins. So there's not a kind of physical impediment to having a system where stable coins can be staked. The question then has to be, for what purpose would you provide stablecoin staking? And I think the only relevant one I can think of off the top of my head is 𝐉𝐈𝐍, the well, actually several of them, and the lending ones, 𝐉𝐈𝐍, 𝐀𝐁𝐎𝐑, things like that, where you could stake a stably priced digital asset, and the protocol could then lend it out and charge interest, and then by staking that stable coin, that stable asset, you would be making a small profit. So for example, 𝐀𝐁𝐎𝐑, by you end up with the 𝐷AI, which is a $1 value token, and people are sort of minting them by locking up assets. So that's one side of things. Another one with 𝐉𝐈𝐍, you could deposit, say, Tether. So that's a $1 token. And people might want to borrow it for a while. So they might put up a volatile asset like Ether, borrow Tether on 𝐉𝐈𝐍, because they think there's some turmoil coming in the Ether markets. And this is a way of them kind of sitting that out without exiting the game completely. So that there are sort of systems where it makes sense. But the thing to remember is the recent EU MiCA regulations, I believe, actually make it prohibited to allow staking of electronic money tokens. So you're not allowed to stake them. They've said that they've said the EU has taken the approach that stable coins are primarily a payment system, not a speculation system. And so they are, if I understood the MiCA regulations, which I have now read 6 times, and it's only marginally more understandable to me than it is before, and I've been very lucky.
And Keir, don't tell me that ChatGPT didn't help you on this.
I don't find ChatGPT that useful once you try to dig into things. It's great for a quick initial summary. When you actually want to dig down, you need to talk to experts. So I've been lucky. There's some chaps over in Lisbon, the University of Lisbon, and BCAS, who have been very kind to give me some time to talk through some of the legal aspects. They're lawyers with an interest in crypto. And it's complicated stuff, and the regulation is not easy to understand, and it's immensely long, and it's also misguided from the perspective that it doesn't really seem to fully understand how the game has changed with decentralization. It's still coming at everything from but surely there is an ultimate authority at the end that we can hold responsible. Surely people can't be anonymous. They equate anonymity with crime.
Here in Switzerland, FINMA last year came up with a suggested very strict regulation around staking services, and requiring that they can only be offered by entities with a full banking license. And of course, that created an outrage here in Switzerland, which is a crypto nation, if you will. There are over 1,000 companies in the blockchain space. Not all of them are in the finance space, but it is definitely a big hub. Were you aware of that? What is your thinking around this?
Yeah, I hadn't seen that particular regulation until you drew my attention to it, and that did give me some time to think about it. And yes, of course, Switzerland is one of the nations that is recognized as being crypto and blockchain friendly, relatively speaking, compared to most of the countries out there. I do find this a bit odd. Firstly, there are plenty of staking examples like the Ethereum one, which are clearly not banking related. They're more to do with sort of capital allocation than to do with sort of it's about making a system work, a technical system work, not about speculating. And the second one is that it doesn't seem to take into account the opportunity for anonymity, right? I mean, this is the thing that the regulators miss time and time again, is there are plenty of people who want to be who want to comply with regulation, who want to be legal, who want to be honest and ethical, but who are faced with such an onerous burden that the temptation is, I can just deploy this contract through Tor anonymously. I can pipe the profits off to an address that I won't touch until I retire to the Cayman Islands or the Seychelles or something like that. And in any case, it's technically fascinating, so I want to do it. I mean, these are kind of motivations that you have. And when you've got that opportunity to do this stuff anonymously very, very easily, the regulators need to make it so that it's in the interests of people who want to be honest, to be honest. And we see this across law, of course. There are bad laws that actually break the legal system because they are excessively onerous, and people go, well, I'll just pay people under the table, you know, we'll just do handshake agreements, we'll avoid involving the law because it's too much of an expense and a hassle. And that regulation you mentioned from FINMA strikes me as one that is saying, you know, if I could launch a contract tomorrow that allows staking, I'm not going to go out and get a banking license to do so.
Yep.
But I could do it in 10 minutes anonymously. The founder of Bitcoin is still not known, right? It's like they've ignored the first person in blockchain and the example they've set in their regulations. So that would be my comment on that.
Yeah. Again, I highly appreciate how you tie together your technical expertise with I would say philosophical understanding of the principles and basically the incentive mechanisms that exist in the market. Here we could talk for hours. I want to close with asking you about your books and about what you're working on now, what you're excited about, and also how many patents and how many children you're nurturing. And I'll put them parallel there. Did I ask too many things?
No, that's fine. I'll answer them in reverse order. So firstly, I have more patents than children, and I have 8 children in total. 7 still live at home. 1 just moved out at the end of last year. So, and I'm a named inventor on 43 patents, I think, at the moment.
What blockchain?
No, blockchain ones are probably about 20 of those, because I've been inventing since 2002 or 2003. And I personally own 13 blockchain patents that I came up with, invented, filed for, and got granted. So that's the patent side of things. I mean, I love patents. It's like it's where law meets computer programming. Patents, drafting patents is a bit, when you get to the claims part at the end, it's a bit like writing a computer program in legalese. So I love that. As for books, well, I've written several. The one I think is worth mentioning on this, if I may show it, is called Evil Tokenomics. And it's a pretty short read. And as a result, it's priced cheaply. And it covers all the sort of tricks of the trade that scammers can use in tokenomics to make a project seem like it is going somewhere and seem like it is above board and honest, when in fact it's just a personal enrichment exercise. And it's written using a fictional character called Maximilian Sorneron, who's got him on the back there, who's walking you through how he's used ICOs and tokenomics to rip people off, because I thought that would make it more of an entertaining read. And if you go to thinkair.com, you can find links to all my books.
Excellent. I'm looking forward to that. I definitely love books that are animated and you know, touch on a lot of points that have some cynicism and a big reality check and an eye opener. So I definitely think that a lot of angel investors for sure should be reading these types of books, or other, you know, day traders that have launched into the DeFi or crypto world because of, you know, the hype and the excitement and the concept of diversification. Let's throw some darts, and you know, even if one of these makes it, we'll be fine, only to find out that that's not the case, right?
Yeah, I think anybody who's thinking of investing some of their money in a token project should really read this. It's not long, and it'll give them a lot more insight than browsing for alpha on various Discord channels.
Okay, so what are you excited about? What are you working on? If you can tell us this year, is there a specific area that you're zooming into in this world of blockchain?
Yeah, well, I'm pretty much a generalist, so I kind of find topics that I find interesting and I dig deep into them, and then I move on to the next one. And then that allows me to sort of connect the islands by having a bigger, broader view. Recently, I've been focusing mainly on security, and
I love your latest video on cybersecurity and CBDCs. I will put in the link for our audience to watch, because obviously my audience talks and thinks, hopefully thinks, hears a lot about CBDCs and other forms of digital money like stable coins and so on. So it is, I think, a relevant issue.
Well, thank you.
Okay, Keir, thank you so much. It was a really great pleasure having you.
That's been wonderful. I've really enjoyed it, Efi. Thank you.